Good afternoon, everyone, and welcome. Thank you all for joining us today on this opening day of the Bretton Woods Committee's 2021 International Council Conference. We are very fortunate to be joined this afternoon by the IMF Managing Director. So I'm going to keep it brief here up front. We kicked off our International Council this morning with a fantastic panel on digital currencies. And we also announced the formation of our new Future of Finance Working Group. That video will be posted on our website, so I encourage you to check that out. But I'm going to be very brief and just remind the audience that we will have time at the end for audience questions. So if you want to send your questions in, please submit them via the Q&A function in the Zoom toolbar. We'll collect those and then we'll unmute you when it's time for Q&A. I also want to thank our International Council sponsors, SICPA Holdings and SCIC, for your generous support of this year's conference. So let me just very briefly introduce Ms. Kristalina Georgieva, Managing Director of the International Monetary Fund, and she will be joined by BWC Vice Chair John Lipsky in conversation today. And so I'm going to just turn it over to John to kick off the conversation with the MD.
Thanks, Emily. And let me give a very warm welcome to the Managing Director, Kristalina Georgieva. It's wonderful that you've been able to take time to join us on what is one of the busiest days of certainly the busiest week of any managing director year, in which everything is centered on the managing director. Now, this has been an extremely eventful 24 hours for the IMF. I'm sure we all saw the statement by the fund board last night confirming their confidence in the leadership of the managing director, a big step forward that's going to allow the managing director, allow you to focus 100% on the fund's responsibility. Congratulations, a great relief and a chance to move forward. I don't know if you want to say a word or two and then we'll move on to the substance.
Yeah. Well, thank you very much, John. You got it exactly right. I am so happy to focus 100% of the work, bringing our fabulous staff, who you know very well, together for the annual meetings and beyond. I am very grateful to our board of directors. They carried out a comprehensive and impartial review, looked into the evidence, and as I expected, once I had a chance to answer all their questions, they knew what I already knew, that the Wilmer Hale report with regard to my role in that story got it wrong. And I am so very keen to see how we move forward, how we can take even more to heart that, as in any big organization, there may be people who feel a little intimidated, how to make sure they're comfortable to always speak up. And I also want to say to everybody who is listening, the board also was very clear in their full trust in my commitment to integrity of our data, but most importantly, in the integrity of our staff and the research the IMF does. So this is, I'm taking advantage of you.
No.
Giving me a chance to say that. Thank you, John.
No, thank you. Thank you for that. And it's, as I know, and you know very well, the members, the fund's member countries need the fund and want the fund to fulfill its duties in the best possible way. And there's a wonderful dedicated staff that want to make sure that that's the case. Yep. And I know you feel grateful to be leading them, and the vice versa, as we say. So now, two other things have happened today from the fund of interest that I think are a good way to start the conversation. The morning began with the unveiling the delivery of the latest World Economic Outlook. And you may have seen the blog that accompanied that. And the title of that blog was A Hobbled Recovery Along Entrenched Fault Lines. Subsequently was the delivery of the latest Global Financial Stability Report. And the fund's blog delivering that was titled Uncertainty Grips Markets as Optimism Fades. So Managing Director. Let's start by asking, what do you see are the key economic challenges in the immediate future?
Thank you, John, for referring to the excellent work we got from our economic and our financial counselors and their teams. What we see today that is different from what we saw 6 months, well, actually in July, not even 6 months ago, is more uncertainty, more risky environment, and divergence that is becoming more persistent. We downgraded our projections for this year only by 0.1%, from 6% to 5.9%. But this is only part of the story. The more important part of the story is the deepening of divergence. In other words, what is the composition of this 5.9%? With advanced economies and some emerging markets that are doing better on vaccines and have fiscal space moving forward. And even if China and the United States have lost a little bit of momentum, the recovery is still strong. Others like Europe, the EU, emerging Europe, gaining more momentum, but the rest of the world finding itself in a very difficult place. Vaccinations falling behind. I was just on a panel with Ngozi, David Malpass, and Tedros. Nearly 60% vaccinations in advanced economies, under 4% in the poor world. And fiscal space that was small to begin with in many developing countries, shrinking even further. Gita uses the term huddled, and I like it very much. For non-native speakers, that is sometimes less easy to absorb. So I'm using a complementary analogy. I talk about walking with stones in our shoes. Yeah. And so what are the stones? Certainly divergence, inflation, debt. And when we look at these problems since last time around, the shadows had gotten deeper, the concerns had gotten bigger. And I want to zero in only on one issue that explains why we should care very deeply for overcoming this divergence. And it is the role it plays in interrupting supply chains and leading to mismatch between demand in advanced economies here in the United States and supply that doesn't quite serve the demand. Why should you care? You know why? Because it puts pressure on prices, pushes inflation up. We still think inflation in 2022 will recede in advanced economies, but not in quite a number of emerging market economies. And even in advanced economies, we have to watch very carefully the anchoring of inflation expectations. Should that happen or be perceived to be happening, you know very well that this can lead to reduced monetary accommodation or withdrawal of monetary accommodation, tightening of financial conditions. So if you are, and I'll stop right here, if you are a country that is slow to return to growth, it's actually falling behind. Employment is still nowhere to be seen in the levels you need it. And interest rates are starting to go up. Your debt level starts to be heavier. That is going to be a tough year ahead of you. We did the numbers. Advanced economies will catch up with their pre-pandemic level, or already have some of them caught up with pre-pandemic levels. For emerging markets, and especially for poor developing countries, we are talking about years ahead. And scarring from the crisis, hammering them from interruptions in education. And just imagine what it would mean for countries in the future to just simply finding themselves in a very tight jacket, no growth, no revenues, and yet expenditures because of the pandemic are up.
Indeed. The potential challenges seem clear. What is the fund recommending to its members about policy moves going forward to confront these near-term challenges?
We came up with a triage that is very easy to understand and remember. Vaccinate, calibrate, accelerate. Vaccinations key. We have this policy package that we propose 50 billion to reach 40% vaccinations in all countries by the end of this year, 70% by the middle of next year. It is doable. The vaccines actually are being produced, but the delivery of vaccines, the schedule of this delivery, the transparency of contracts leaves still room for improvement, rather big room. And then we have the issue in countries, you get the veil, but if you are in DRC or in Mali, how do you get this veil to turn into a shot in the arm in a remote village? So that vaccinating the world is still something that we have to all press for very, very strongly. Calibrate, in a way, last year, as terrible it was in terms of uncertainties caused by the pandemic, it was, from a policy response standpoint, easier. Once we diagnosed the crisis, that it is both supply and demand, and then we said, provide fiscal support, keep the receipts, provide fiscal support, provide monetary accommodation. It was kind of universal blanket in all countries for households, for businesses. This year, we cannot anymore do that. We don't have the fiscal space to do it. Neither it is right. So how do you target those who need this support? How you gradually withdraw the support? How do you put a medium-term fiscal consolidation anchor that gives confidence to businesses and to consumers? Much more complicated, much more country specific. And that, to the fund, puts pressure for us to step up our surveillance work in countries quite aggressively, so we can be giving this calibrated advice. And calibrated program support should that be necessary. And then accelerate. We have to walk on two legs. We have to deal with the short-term problems, and we have to recognize that this is probably the most complex policy challenge, because you also have to turn your economy to a low-carbon, climate-resilient, digital, and inclusive path. And that accelerating this, in our view, is very, 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 very important.
Then, since we're on the eve of the meeting of the International Monetary and Financial Committee of the Board of Governors to look at IMF initiatives, what are the key IMF initiatives that you foresee to, or that you're going to be recommending to aid progress toward a better global recovery?
So what we are concentrated on is first, in the area of vaccinations, working in this so-called multilateral leaders task force with the World Bank, WHO, WTO, to gear through better data, better coordination, more transparency, the vaccination, especially in developing countries where it is way behind, below 4%. On the question, and there we continue, John, with our analytics on the economic case and how that can be done in the most efficient manner. Secondly, we are very much focused on the issue of debt. There, what we are pressing together with the World Bank is to take lessons from the common framework so far and make sure that the common framework can deliver, because it has been slow to deliver.
Yes.
We know that the debt service suspension initiative is expected to expire in the end of the year. If the common framework doesn't gear up to accommodate cases of high debt distress, we're going to have a problem. Yeah. And we continue to work on how to make sure private sector participates, what more we can do in the international debt architecture. This is going to be a big, big topic. Third, and obviously we work on the analytics around inflation, sound fiscal policy, all the work that the fund has been known for. On the issue of accelerating the transformation, we do have something exciting, and it is not only we are creating more capacity to lend to countries in highest need for concessional finance, that is low-income countries, through the Poverty Reduction and Growth Trust. We reformed this trust. That it used to be differentiated from GRA financing. Now they're equal. We increased access level by 45%. So if you are a low-income country with a strong program of reforms, you can tap into sufficient financial resource to carry this program forward. But in addition to that, we are creating what we call Resilience and Sustainability Trust, a new instrument to on-lend SDRs of the new allocation. Well, actually, it can be from the old allocation too. Yes. From countries that have it, don't need it so much, to countries that really need an impulse for this transformational policy shift. So if I'm to be thrilled about the transition from pre-annual meetings to annual meetings, it would be Friday board meeting on Resilience and Sustainability Trust. I think it went for over 4 hours. Very detailed discussion on eligibility, financial arrangements, partnership with other organizations, and very strong support for it. So I hope we will see in the meetings that support to grow among the governors and take us forward. Why does it matter? Because what it provides to the membership is a complement to the existing instruments of the IMF that is, I hope, to be in place in about a year time in action, in implementation, that makes the fund a more active participant in helping countries steer away from future balance of payment crises that are due to their misalignment with that transition to the new climate economy, to the digital economy.
Do you anticipate that the RST, that the Resilience and Sustainability Trust, will be an important channel for for providing support via the SDR allocations to needy members?
Based on what we hear from the membership, yes. Obviously, we don't want to bite more than we can chew.
Yeah.
We are looking at somewhere indicatively between 30 and 50 billion that may grow over time. And of course, it can also have, because it is going to be associated with fund programs, it would have policy influence over fund programs from the bread and butter financing from the IMF.
Mhm. Now, another important trend is that you mentioned digitization, and nowhere is that more evident than the rapid transformation of the world's financial system
Yes.
in so many ways. How do you see the fund's role in this process that inevitably will have an impact on the international monetary system?
So I actually was thrilled when I heard that you started the day with digital currencies.
Yes, yes.
And actually, I should have said that because this is going to be a big part of the discussions in the meetings. What we are doing now is we are stepping up our work in this arena on 4 counts. One, our capacity to help members identify pathways, whether they should take them or not, for central bank digital currencies. We did a survey of the members, and I was so impressed. 110 tell us that they're at some stage of looking into this very early, or as it is the case with the Bahamas, coming up with the first CBDC on the planet. And that interest, of course, we work with BIS. BIS has advanced in this area a lot, but BIS doesn't have universal membership. And now small members are saying, hey, how about us? So this is number one. Number two, looking into the privately issued digital currencies, from M-Pesa to the to USD, e-money, stable coins. They are guaranteed with assets. How this is going to be regulated? We obviously are not regulators, but we have to be a transmission line for our membership on that. Thirdly, deepening our understanding of digital assets, Bitcoin and the rest that are called money. They can be used certainly as money, but they're not quite money because of the volatility of the value they store. Obviously, after El Salvador, this is an issue we have to be able to work with our membership. And the fourth is super important, and it is cross-border payments. And how the global monetary system is going to change, given that we are moving in very rapidly in this place. What we assess is 3 things critical: trust, how we make sure that this is trusted. Second, domestic stability. Is this transition to more digital helping monetary policy and stability in the country? And the third issue is international stability. And that, John, is straight into our alley. And we have to obviously be one of the key players in this field.
Exactly. And from the panel this morning, by the way, there was great emphasis on the potential problems created by the fragmentation of regulatory standards.
Yep.
And of interest, although people like to talk about Bitcoin and things, that stable coins are very much like money market funds and many similarities. And there are financial stability risks there that are probably underappreciated. This is certainly an area where they know the fund is going to be paying attention.
Absolutely. And that, if I may, this is what actually got us just a couple of months ago worried that the speed with which this is moving in different parts of the world without common standards, interoperability, more understanding of these risks is where the fund has to move very quickly.
Exactly, and certainly in partnership with the FSB.
Of course,
there needs to be good cooperation, but you appreciate that as much as anybody. 2 other themes that you've emphasized for the fund that have attracted some controversy. Climate and inclusion. I happen to be one to think that these are important issues for economic policy, and that's natural for the fund. But perhaps you'd like to say a few words.
Yes. Look, I appreciate people being watchful. Is the fund doing the right thing? And anything that any inputs in that regard, we value them. But let me make you the case. And by the way, we have a board-approved strategy on climate change. It's not like we are running loose with this. And there have been multiple engagements with the board on why inequality matters for growth and prosperity, or actually addressing inequality matters. On climate, we already are seeing climate shocks affecting balance of payment, affecting macroeconomic stability, affecting growth and employment. We are already seeing the financial stability risks associated with both these physical shocks, but also with transition to a low carbon future, which is going to be a necessity if we want our kids to survive. We at the fund, we have to understand from the perspective of macro stability and financial stability, how these climate policies have to be integrated and how they should be prioritized, how they should be integrated in fiscal policies. If the world is moving in many parts towards taxing carbon, how could the fund say, oh, you know what, none of our business? If we are seeing increasingly in developing countries worries about their reliance on hydrocarbons in a future that we don't know how that would work, how can we not be engaged with them on this issue? So I feel, and on inequality, that's actually not new. I mean, the economic profession for a long time has been looking at inequality as a source of friction in terms of the foundation for growth and prosperity. So I feel that we cannot be blamed at the fund for thinking of applying our mandate in a rapidly changing world in a way that is helpful to the membership. And while there are voices of criticism, there is also a great deal of interest. And that interest is from the membership, which of course matters to us. Exactly.
Thanks for that. Now, we've promised our audience that they have a chance to ask some questions as well. Our executive director, Emily Slater's been collating questions. Emily, what do we have?
Yes, thank you. Thank you, John, and the managing director. We do have a couple of questions from the audience. I am going to first go to Frank Vogel. Frank, are you there? And can you please unmute yourself?
Yes, I'm here. Can you hear me?
We can hear you. Please go ahead.
That's so good of you. Thank you. Thank you, John and Emily. Madam Managing Director, I think it's wonderful that the IMF in the last few years has done so much to really try and work closely with civil society organizations. I'm the chairman of a group called the Partnership for Transparency Fund and the co-founder of Transparency International. We appreciate that cooperation. We also appreciate greatly the work the fund has increased doing on corruption. So my question, we're at a point where you have called for a very large increase in the flow of funds to many developing countries who clearly have been hit by the pandemic. We are very concerned as we look at the Pandora Papers, as we look at the latest reports on money laundering, and I have a new book on that subject, we are very concerned indeed that the fund is not working as closely as it could with in-country civil society, before all the money is dispersed to make sure this cash is not being stolen. And when we look at Lebanon and we look at Zambia and other countries defaulting, we are very, very concerned that we're heading for a bad debt crisis due to increased corruption. And I appreciate your comments. Thank you.
Thank you for this question. When we stepped into the pandemic, we realized that provision of financial lifelines would be only effective if we complement it with measures to audit where the money goes. We just published a paper that sums up the experience we have accumulated in different countries, and I would be the first to admit that it is a learning process. We, in the very beginning, we were not actually clear that we would have to do so much for so many, but with time, there has been a very significant attention exactly to that. How do we audit them? How do we trace the money? How we audit the money? How we can be comfortable that it is well spent? I don't have the link to the paper, but I would make sure, Frank Vogel, I would make sure that we get you this link. One of my colleagues here is taking note of that. But you're asking a broader question, and it is how to engage more proactively with civil society to be on the alert of what risk that may be there, not auditing after the fact, but being more aware of governance issues in advance. We have been expanding our engagement with civil society, especially on this issue of corruption. And I can only take it to heart to say we will move on this more actively, given that you have eyes and ears on the ground. And in many countries, we don't. We may have one resident representative, and then we have missions, and with pandemic, they're virtual. So actually, I would say thank you for the offer. On Zambia and Lebanon, I see them as different. Why? In Zambia, the elections brought a new president with a team very committed to address the debt burden on Zambia and to do that transparently with high level of accountability. I'm hopeful that we would see our engagement with Zambia on a program, and Zambia, they have requested treatment under the common framework, doing a good job and actually setting up a good example for others to follow. The president was here. I met him, I think, about a week ago, and what we see, and if you have other observations, I would be very interested. But we see a change in tone and attitude and in openness in Zambia. Lebanon is a much more difficult story. Breaks my heart. A country that has wonderful entrepreneurial people being brought down by inability to form a strong government. Now we have a partner there. We will obviously work closely. But on Lebanon, I would take your offer very much. I will pass it to our mission chief because it has been as you know very well, a very sad story.
Thanks very much. Emily.
Thank you. Yes, we have another question on debt, a related question. So I'm going to pass it over to Mahesh Kotecha to pose his question on debt. Mahesh, are you there?
Yes, thank you very much. Can you hear me?
Yes, please proceed.
Thank you very much, Madam Managing Director. My question, first of all, congratulations on the decision last night. It is so heartening to have stability at the head of the fund. And my congratulations and good wishes. My question is regarding the common framework. As you know, there's much interest in having the private sector participate, but the private sector is not the public sector. The private sector can do things the public sector cannot do. It has more money, but less capacity to negotiate directly with governments. The way to, it seems, to engage the private sector is to figure out a way where it is not thought that money not used to pay the governments is actually being misused to pay the private sector. One can ring fence the debt relief so that it is given priority to pay for health, priority for climate issues, and not for repayment of the private sector debts, for which other resources can be used. If that were to happen and defaults were not made on private sector debt, more money can flow, more money than the public sector combined. So what about ring fencing the use of proceeds and not talking about the fake fungibility of money? Money is fungible to some extent, but it can also be ring fenced.
You're making a very good point that countries being suffocated by debt, especially that has not led to productive investments. I mean, let's remember that is not necessarily a bad thing. If you borrow and then you invest in the skills of people, in infrastructure, in digital infrastructure, in productive assets, that raises growth and it pays for itself with a plus for society. But if we have situations in which this is not done, that money is wasted, you have a kind of a white elephant project that contributes nothing but sucks away resources, that of course is a problem. I would answer your question with 2 points. Point number one, we believe very strongly that what must improve fast is debt transparency. If we don't have an idea what is the debt composition, under what conditions, then even debt restructuring becomes a real problem. We have been working in our programs to lift up debt transparency, and if civil society voices are added to that, I would be very grateful. Whether it is public debt or private debt, it has to be transparent. When it comes down to private debt, we have to have situations in which private investments, often in developing countries with high rate of return or with high interest rate, if it is a loan, then expect that if things go wrong, they would be bailed out. Well, you take more risk, you get a higher return, but you also have to be prepared to have a haircut. And that is where we are so keen to move the discussion around debt restructuring, base it on debt sustainability analysis from the fund, and make sure that everybody participates, that private sector also participates. Ring fencing, I understand your point. We actually do advocate for a little bit of this because we say social expenditures have to be protected. They cannot go below a certain level. We haven't gotten to a point of thinking of climate expenditures as also being protected. I'm not going to speculate how we would answer it, but I just wanted to say to you that some ring fencing, the fund has already accepted as a necessity, and we advocate for it.
And as director, of course, your interjection is music to my ears. As I think you know, the Bretton Woods Committee has formed a sovereign debt working group under the leadership of Bill Rhodes, my co-vice chair, Bill Dudley, our chair, and very, very talented and experienced collaborators, colleagues. And we are working on a series of detailed position papers. The first that is imminent is exactly on debt transparency, exactly with the idea that if you don't know what you're dealing with and not confident you know what you're dealing with, how can you provide adequate treatment? And in fact, Friday morning, we'll be holding a panel that I'm sure you're going to be too busy, but we hope lots of folks will participate. And we're in touch with your senior colleagues, and we will be exchanging insights with them and trying to be helpful and supportive. So thank you very much for that. Do we have time for one more quick question, Emily?
I think we've run out of time, and I know the managing director has many
some other things to
obligations.
do.
They're waving
So
at me, John. Yes, they are waving here that I need to go.
we will leave it
But
there.
I didn't say thank you to the second question. Thank you for what you said about stability at the fund. Thank you.
So thank you so much for taking time out of this, as I say, incredibly busy time. Congratulations also once again, and focus 100% on the important tasks of the fund as you described here, and best of luck on making progress on the fund's initiatives in these critical areas. So thank you very much.
Thank you, John.
Yep.
Thank you,
Thank you.
everybody. And thank you for being interested in the institutions.
We will.
Thank you to the
They're
managing
important.
director. Thank you, John. Thank you for the excellent questions from our members. Join us here tomorrow as we continue the International Council, 10:30, session with the U.S. Deputy Treasury Secretary. So hope to see you all then. Thank you very much.